2024 is a fresh start. And for many of you, this is the year that you're planning on purchasing a home. But there's some things that you're gonna wanna need to do before you start that process. I'm gonna give you 3 tips, and this is gonna be a 3-part series, this being part 1, and tips to help you prepared. So let's get right into it. Now, the big buzzword in all of 2023, aside from inflation, was credit card debt. As a nation, we carried over $1 trillion in credit card debt. And with higher interest rates, people were carrying that debt for longer periods of time, which means they were shelling out lots of money every single month to pay those bills down. Now, according to a bank rate survey, the top New Year's resolution, or the top resolution for 2024 for most Americans was, you guessed it, paying down credit card debt. So how is that going to help you in the home buying process? Well, let's talk about it, because you're going to want to need to get credit worthy. The first thing I'm going to have you do is pull your credit report from the credit repositories. You can do this at annualcreditreport.com. They're going to give you 1 free report per repository every 12 months. So if you're planning on purchasing right away, I would say go ahead and order all 3. You're going to get 1 from Experian, 1 from TransUnion, and 1 from Equifax. However, if your purchase isn't coming until maybe the middle or later toward the end of the year, then only order 1 right now. And the reason is because more chances than not, all of those reports are going to have the same information. Now, they'll vary a little bit from repository to repository because everything that each one of those requests isn't always the same. So for the beginning, you want to order 1, right? You're going to look at that and see if there's any errors on that report. If there are, you want to dispute those, and you can do that online. The next thing you're going to want to look at is what items could negatively affect your credit report, or actually which ones are negatively affecting your credit report. So for instance, I did a video on how lenders kind of score, what scoring models they use when pulling your credit report. You can watch that. I'll leave a link for that in the description below. But you're gonna wanna look at those items. So things that are like high credit card balances or student loans, anything like that, right? You're gonna wanna look and see which items negatively affect your report. The reason you're looking at that is because when lenders go to qualify you, they're gonna use something called your DTI, or debt to income ratio. That's where they look at how much debt you have each month versus your earned income. If that number is 45% or lower, you're probably good to go. Most lenders like to see it around 36%. If you're hovering around 50% or even higher, chances are it's going to be more difficult for you to get the loan. I'm not saying impossible, but finding a lender to do that is going to be very challenging. So you want to just be able to pay down those debts as fast as you possibly can. Now, when you pull those credit reports, they will not contain your FICO score. And your FICO score is going to be important because it's like the number lenders look at to determine whether you're credit worthy. In other words, can we trust you to repay back the money that you borrowed from us? Now, typically any number that's 740 or above is considered excellent. And obviously, the better number you have, the better rates and terms you're going to get from a lender. Now, it doesn't mean that you have to have a 740. It just means that if you have a 740, chances are you're going to be in pretty good shape. But you can still qualify for a mortgage even with a credit score as low as 580. That means you would probably be getting an FHA loan. Now, those loans are typically going to carry higher interest rates, but the down payment is going to be far less. So for FHA, you're talking about 3.5%. Conventional, you probably can go as low as 5%, but those are going to vary depending on the type of home and kind of some other factors relating to what's in not just your credit report, but when they look at you as an overall buyer. If you recall, I told you that the higher your FICO score, the better chances are you're going to get better rates and better terms. But in your score, there are some pieces that are going to be significantly more important than others. So for instance, I mentioned loan amounts. So if you have high outstanding balances, that is a huge part of your FICO score. In fact, it comprises 35% of your score. So the more outstanding debt you have, the lower your score is going to be. So if you are carrying 3 credit cards, and let's say that each of them have a limit of $10,000, and you're at $8,000 on each of those, that's going to lower your score significantly. So the faster that you can pay those down or even pay those off, the better. It'll increase your score dramatically, and it's going to give you better terms and rates for any mortgage that you apply for. Next, you're going to want to look to see, do you have any late payments? If you do, That's going to be a huge blow to your score because that comprises about 30% of your score. Now, this one's not a quick and easy fix, right? When you have late payments, they generally will stay on your credit report for a number of years. However, you can try writing to the creditor and explaining the circumstances as to why you were late. Now, again, it's not going to be a quick and easy fix because they're going to want to see kind of a consistent history of you paying on time. So let's say they may say agree to it, but they may say we'll only take it off after 3 or 4 or 5 months of you showing that you're paying on time and you're paying the balance, not necessarily in full, but you're making the minimum payment requirements and you're paying those on time. If you do that, there's a chance that you may, I'm not saying that you will, that you may be able to get those things knocked off your credit report and it'll boost your score drastically. Here's another tip. When you're looking at your credit report, you might see some old credit cards that you have paid off or some old accounts that you have probably paid off or whatever the case may be. Do not delete those off your credit report. And I'm going to tell you why. So some people think that, oh, I've got this old credit card. I don't even use it anymore. I'm just going to have them delete that I'm going to close that account. So it's going to get deleted from your credit history. Your credit history makes up about 15% of your score. And because the longer that you have your credit, the better your score is when you start deleting old lines of credit. So for example, if you have like an American Express card and you've had it for like 15, 20 years, whatever the case may be, and you decide, oh, I don't even really use that anymore, and you close that account, that whole credit history is wiped away. So it's like it never existed. That's going to drag your score down. Coincidentally, don't go out and open new lines of credit. So don't go out and open up 3 additional lines of credit that you don't really need. People will think that, okay, if I open new lines of credit, I can change my credit utilization rate and that'll boost my score. Maybe and maybe not, because what it's looked at is that you're borrowing more, you're applying to borrow more, which means that you may be overextended. Not to mention that when you have additional credit cards, you may have the propensity to want to be tempted to actually use those cards when you don't need to. And the more you use those cards, the more outstanding debt you have. The more outstanding debt, that's going to lower your DTI, which again, if you're at 50% or higher, could make it challenging for you to get a mortgage. Now, you might be saying, yeah, I hear you, Dietric. I'll work on my credit. This is cool, but it's not that big of a deal. I can figure out ways around that. Well, you might, but here's the truth about the matter. Lenders are going to look at that FICO score. They have ranges of FICO scores in which they assign specific interest rates. Now, it's going to vary from lender to lender. So I'll kind of give you an example through my FICO. If you have a 740 score, you would have an interest rate of about 6.4. If you had a 620 score, you would get an interest rate of 7.4. So that 120 point swing cost you 1%. And it's the difference between, let's say, paying $1,800 a month and about $1,600 a month. That $200 per month may not seem huge. For some of you, that's probably an extra car payment. But if you look at that over the course of a year, that's $2,400. But your loan is probably going to be 30 years or 360 months. If all this seems overwhelming, don't worry. I have some solutions in place to help you get credit ready. Now, after that, you're probably going to want to go talk to a lender. Pump your brakes though, because there are some other options that are available for you that I'm pretty sure you may want to take advantage of. And I'm going to talk about those in part 2 of the series. So stay tuned.